Retail was panic selling. Whales were quietly buying. Why? The exact moment thousands of traders slammed the sell button, the biggest players did the opposite. Wallets holding tens of thousands of Bitcoin were buying this dip, completely against the crowd. The story you're being told about this dip is the exact inverse of the data. Bitcoin just dropped towards $62,000 in a fast, painful move. Over $830 million in positions were liquidated in a single violent flush. If you only watched the price in red candles, you'd think the top was in, but that's just the surface. Today, we're going underneath it, all the way down. On-chain data, exchange flows, the Fed narrative, and the technical structure. We're breaking it all down. When you put it all together, a very different picture emerges. Trust me. Stick to the end. The last third holds the real edge nobody's talking about. And that distinction between mechanical, forced selling, and genuine conviction selling is the single most important thing to understand about where we are right now. Because those are two completely different signals wearing the same red costume. So why did the drop happen in the first place? What was the catalyst? There were really two major forces that lined up at the same time, and when they hit together, they created the perfect storm for a leverage flush. The first is the Federal Reserve. Over the past week or two, the tone coming out of the Fed has shifted noticeably more hawkish. Fed Governor Christopher Waller made comments that the market interpreted as signaling the Fed is far more concerned about persistent inflation than about supporting risk assets. And there's growing chatter about the Fed potentially keeping rates higher for longer, or even the possibility of another hike being back on the table rather than the cuts the market had been pricing in. Now, why does this matter for Bitcoin? Because Bitcoin, despite being called digital gold, still trades like a high beta risk asset in the short term. When the Fed sounds hawkish, when interest rates are expected to stay elevated, money gets more expensive, liquidity tightens, and speculative assets, tech stocks, growth stocks, and crypto tend to get sold off first. It's the cost of money going up. Higher rates mean the risk-free return you can get just sitting in treasuries goes up, which makes holding a volatile asset like Bitcoin comparatively less attractive to short-term money. So Waller's hawkish signal was gasoline on a market that was already sitting on a pile of leverage. The second catalyst is closer to home for Bitcoin specifically, and it's about the single most famous corporate Bitcoin buyer on the planet, Michael Saylor's company, Strategy, the firm formerly known as MicroStrategy. For years, Strategy has been the relentless, unstoppable buying machine of the Bitcoin market. Every week, it seemed like they were announcing another purchase, scooping up thousands of Bitcoin, providing a constant, reliable source of demand that put a floor under the market. But that's changed. Strategy has paused its Bitcoin buying. According to filings, they stopped their weekly acquisitions for the first time in months, choosing instead to rebuild their cash reserves. Their stock has been under serious pressure this year, down significantly, and analysts view, including firms like CryptoQuant, have been openly urging them to slow down, prioritize cash to cover dividends and debt obligations, and stop overextending. So when the market's most dependable buyer suddenly steps back, it removes a psychological and structural support that a lot of traders had been leaning on. It's not that Strategy is selling, they're not dumping their stack, but they've stopped adding. And in a market that had gotten used to that constant bid, the absence of it is felt. So you've got a hawkish Fed tightening the liquidity screws, and you've got the biggest structural buyer pressing pause, and you've got a market loaded up with leverage. Put those three things in a room together, and you get exactly what we saw. A sharp, fast, painful flush towards $62,000. That's the bearish surface story, and it's real. I'm not going to pretend those catalysts don't matter. They do. But now we go underneath. And this is where it gets genuinely interesting. While all of this was happening, while the price was dropping, while the liquidations were cascading, while the headlines were screaming about the Fed and Saylor, the on-chain data was telling a story that most people scrolling their feeds never saw. Because the whales, the largest holders in the market, were not panicking. They were accumulating. On-chain analytics showed Bitcoin whales withdrawing thousands of Bitcoin off exchanges and moving them into cold storage during the exact window that retail was capitulating. We're talking about wallets pulling over 11,000 Bitcoin, roughly $700 million worth, off exchanges and into long-term storage as retail panic sold the $60,000 region. And this fits into a much larger pattern that's been building for months. Whale wallets, the addresses holding between 1,000 and 100,000 Bitcoin, have accumulated something on the order of 270,000 Bitcoin over a 30-day accumulation window, which at current prices is worth around $16.5 to $16.7 billion. This has been described as one of the largest whale accumulation waves in years. Now, why does it matter whether Bitcoin is sitting on an exchange or in cold storage? This is a crucial concept, so let me break it down. When Bitcoin is held on an exchange, it's liquid, it's ready to be sold at a moment's notice. High exchange balances generally mean more potential selling pressure. The coins are sitting there, loaded in the chamber, ready to fire. But when Bitcoin moves off an exchange and into cold storage, a private wallet offline, self-custodied, it's a signal that the holder is not planning to sell anytime soon. They're taking their coins off the market, out of circulation, and locking them away. So when you see whales pulling Bitcoin off exchanges during a price dip, that's not the behavior of someone who thinks the price is about to collapse. That's the behavior of someone who thinks the price is cheap and wants to hold for the long haul. It's the on-chain equivalent of someone quietly buying up all the discounted inventory while everyone else is running for the exits. And this is a pattern we've seen play out over and over across Bitcoin's history. The people who get shaken out at the bottom are almost always retail. The smaller, less experienced, more emotional participants who buy near the top when it feels safe and euphoric and sell near the bottom when it feels terrifying. The people accumulating at the bottom are almost always the whales, the long-term holders, the entities with the deepest pockets and the longest time horizons. There's a name for this dynamic, and it's one of the most important concepts in all of crypto. It's the transfer of coins from weak hands to strong hands. Weak hands are the traders who fold under pressure, who can't stomach the volatility, who capitulate at the worst possible moment. Strong hands are the holders who accumulate through the fear, who see a dip as an opportunity rather than a threat, and who have the conviction and the capital to hold through the pain. And right now, on-chain data suggests we're in the middle of one of these transfers. Coins are moving from weak hands to strong hands, from retail to whales, from exchanges to cold storage. Let me hammer this home with the sentiment data, because it reinforces everything I just said. The Crypto Fear and Greed Index, a metric that measures overall market emotion on a scale from 0, which is extreme fear, to 100, which is extreme greed, is currently sitting deep in the fear zone, hovering around 20 to 22, which reads as extreme fear. Now here's the contrarian lesson that separates the pros from the amateurs. Extreme fear is historically one of the best buying opportunities in Bitcoin's entire history. Think about it logically. When is Bitcoin cheapest? When everyone is terrified? When is it most expensive? When everyone is euphoric and greedy. The index being pinned in extreme fear means the crowd is scared, sentiment is washed out, and a huge portion of the weak selling has likely already happened. Warren Buffett has a famous line that applies perfectly here. Be fearful when others are greedy, and greedy when others are fearful. Right now, others are extremely fearful, and the whales, they're being greedy. The data proves it. But, and this is important because I'm not here to sell you a fairy tale. I want to be balanced and honest with you because that's how you actually make good decisions. Extreme fear and whale accumulation are powerful bullish signals, but they are not a guarantee. Fear can always get more extreme. Whales can be early. And there are legitimate bearish forces in this market that we cannot ignore. So let's talk about the other side of the ledger, honestly. The first real bearish concern is the ETF flow picture. Spot Bitcoin ETFs were one of the biggest bullish stories of the last couple of years. They opened the floodgates for institutional and traditional money to buy Bitcoin through a regulated familiar wrapper. But recently, those flows have turned choppy and at times sharply negative. There have been stretches of significant net outflows, with hundreds of millions and even over $1 billion, leaving these funds across multi-day windows. Some analysts have gone as far as to describe it as a structural break in institutional demand. Now, ETF flows are one of the clearest windows we have into what big traditional money is doing. And when that money is flowing out rather than in, it removes a major source of buying pressure. It's worth noting the picture is genuinely mixed. There have also been days and weeks of renewed inflows, and July has recorded some net positive inflows in certain windows. But the overall trend has been far less one-directionally bullish than it was during the peak of the ETF hype. So this is a real headwind, and anyone telling you it isn't is selling you something. The second bearish concern connects back to what we already discussed, the Fed and the macro environment. As long as the Fed remains hawkish, as long as rates stay elevated, as long as the market fears tightening rather than easing, Bitcoin is going to face a stiff headwind from the macro side. Bitcoin does best when liquidity is abundant and money is cheap. Right now, that's not the environment we're in. And until the Fed's tone softens, until we get cooler inflation data or a genuine dovish pivot, this overhang isn't going away. The third concern is the nature of any bounce we've seen. Some of the recent upward moves have been driven not by genuine, sustainable spot buying, but by short squeezes. A short squeeze happens when traders who are betting against Bitcoin, the shorts, get forced to buy back their positions as price rises, which pushes price even higher in a temporary mechanical spike. The problem with short squeeze rallies is that they're often hollow. They're not backed by real conviction demand. They're backed by forced buying that exhausts itself quickly. And once the squeeze is done, if there's no genuine buying underneath to hold price up, it can fall right back down. So we have to be careful not to mistake a mechanical squeeze for a real trend reversal. And there's one more warning sign worth mentioning from the technical side, which brings us perfectly into the chart analysis. Some longer-term technical readings have flagged the potential development of a head and shoulders pattern, one of the most well-known bearish reversal patterns in technical analysis. If that pattern were to fully form and confirm with a break below its neckline, it would open the door to significantly lower targets. I don't want to fearmonger with a specific number because these patterns often fail and are frequently invalidated, but it's on the radar, and being aware of it is part of being a disciplined, honest analyst rather than a permabull cheerleader. Okay, so now let's put on our technical hats and talk about the actual chart, because this is where you turn all this narrative into a concrete, actionable plan. Levels matter, structure matters. Let's go through it. The most important level in the entire Bitcoin market right now is the 200-week moving average. This is the average price of Bitcoin over the last 200 weeks, roughly 4 years of price data smoothed into a single line. Why is it so important? Because historically, the 200-week moving average has acted as the ultimate bull market floor. In previous cycles, Bitcoin has only very briefly dipped below it during the absolute deepest, most brutal points of bear markets, and those moments turned out to be generational buying opportunities. As long as Bitcoin holds above this line, the long-term bull structure is technically intact. That line currently sits in the low $62,000 range, which means we are right now testing it. This is not a random price level. This is the line in the sand that separates a healthy correction within a bull market from a potential deeper breakdown. So watch it closely. Now let's map out the specific support levels, the price zones where buyers are likely to step in and defend. The first and most immediate support is right around $61,000 to $62,000, which overlaps with that 200-week moving average and the recent lows. If Bitcoin holds here and bounces, that's a strong sign that this level is being defended and that the dip is being bought. Below that, the next major support zone sits around $60,000, a huge psychological round number where a lot of buy orders tend to cluster. 60,000 has been a battleground level, and holding it would keep the structure healthy. Below 60,000, we're looking at a deeper demand zone in the 58,000 to 58,500 region TRO. Some analysts point to 58,350 as a key level where real buying interest historically returns. And then, if things got truly ugly, the last-ditch support would be down in the mid-50,000s, the 56,000 to 57,700 region, which represents a kind of final floor. I want to be crystal clear. I'm not predicting we go there. I'm mapping the terrain so that no matter what happens, you have a plan and you're not caught off guard. A drop to any of these levels would be painful in the moment, but would not necessarily invalidate the longer-term bullish thesis unless we saw a decisive, sustained weekly close well below the 56,000 area. Now, the resistance levels, the price zones where sellers are likely to appear and slow down any rally. The first hurdle is right around $63,000 to $64,000, which is where Bitcoin got rejected on its recent attempt to push higher. Bulls need to reclaim this zone and crucially close above it on higher timeframes to prove that momentum is genuinely shifting back to the upside. Above that, the next major resistance is at $66,000, a level that has repeatedly acted as a ceiling. Clearing 66,000 with conviction would be a genuinely bullish structural development. Beyond 66, the bigger picture resistance clusters around the 70,000 to 72,500 region, where a cluster of major moving averages sits. Reclaiming that zone would essentially confirm that the correction is over and the next leg up is underway. So the roadmap on the upside is clear. Reclaim 64, break 66, and then challenge the 70 to 72,000 cluster. Each level cleared is a step toward confirmation. Let me also touch on the RSI, the Relative Strength Index, because it's one of the most useful momentum tools, and I want you to understand what it's telling us. The RSI measures whether an asset is overbought or oversold on a scale of 0 to 100. Above 70 is generally considered overbought, meaning the move may be overextended and due for a pullback. Below 30 is generally considered oversold, meaning the selling may be overdone and a bounce could be coming. Just a few days ago, when Bitcoin was pushing 64,000, the RSI had actually climbed toward overbought territory, which was a warning that the rally was getting stretched and vulnerable to exactly the kind of pullback we then got. Now, after this flush, the RSI has cooled off considerably, unwinding that overbought condition and moving back toward more neutral or even slightly oversold territory. That's actually healthy. An overbought market that cools off and resets is far better positioned for a sustainable move than one that just keeps stretching further and further into overbought extremes before snapping violently. So the RSI reset here is, on balance, a constructive development. So now let's zoom out and synthesize everything, because this is the part that ties it all together and gives you the actual takeaway. Here's what we know. On the bearish side, the Fed is hawkish, liquidity is tight, strategy has paused its buying, ETF flows have been choppy and at times sharply negative. Some recent rallies were hollow short squeezes, and there's a potential bearish pattern developing on the longer-term chart. On the bullish side, whales are aggressively accumulating and pulling coins off exchanges into cold storage. We've just seen one of the largest whale accumulation waves in years, totaling around 270,000 Bitcoin worth roughly $16.5 billion. Sentiment is pinned in extreme fear, which is historically a contrarian buy signal. The recent liquidation flush cleared out over-leveraged longs, which actually resets the market and reduces the fuel for further downside cascades. The RSI has cooled from overbought back toward neutral, and Bitcoin is testing the 200-week moving average OSCERS, the single most reliable long-term bull market floor in its history. What does that combination actually tell us? It tells us we are at a genuine decision point, a pivot. This is not a boring, low-stakes moment in the market. This is one of those junctures where the next few weeks could set the tone for the next few months. And the way I read the balance of evidence, and this is my read, not a promise, not financial advice, is that the on-chain and sentiment data are quietly bullish beneath a bearish-looking surface. The smart money is doing the opposite of the crowd. That doesn't mean price can't go lower first. It absolutely can. Whales are often early, and they have the capital to sit through drawdowns that would wipe out a leveraged retail trader. But when the largest, most informed, most well-capitalized participants in the market are accumulating into fear while the crowd capitulates, history suggests that's usually the side you want to be aligned with over a long enough time horizon. So let me give you 3 concrete scenarios so you're prepared for whatever actually unfolds, rather than betting everything on a single prediction. Because the traders who survive and thrive are the ones who plan for multiple outcomes, not the ones who fall in love with one prediction. Scenario 1, the bullish reclaim. In this scenario, Bitcoin holds the 200-week moving average and the 61 to 62,000 support. The whale accumulation proves prescient, and the Fed narrative softens even slightly, maybe a cooler inflation print or a less hawkish comment. Bitcoin then reclaims 64,000, pushes through 66,000, and starts working toward that 70 to 72,000 cluster. In this scenario, this dip becomes the accumulation opportunity that everyone who panic sold will wish they'd taken advantage of. The signs to watch for confirmation: a strong daily and weekly close back above 64,000, ETF flows flipping decisively positive, and the fear and greed index starting to climb out of extreme fear. Scenario 2, the grind and chop. In this scenario, Bitcoin doesn't crash, but it also doesn't rocket. It gets stuck in a choppy, frustrating range between roughly 60,000 and 64,000 for a while, as the market digests the macro uncertainty, waits for the Fed to give clarity, and slowly builds a base. This is actually a very common and healthy way for markets to behave after a big move. They consolidate, they build energy, they let the moving averages catch up, and they shake out impatient traders before the next real move. In this scenario, patience is the name of the game. Nothing gets decided quickly, and the winners are the ones who don't get chopped up trying to trade every wiggle. Scenario 3, the deeper flush. In this scenario, the bearish forces win the short-term battle. The Fed stays aggressively hawkish, ETF outflows accelerate, the 200-week moving average breaks, and Bitcoin flushes down toward that 60,000, then 58,000, and potentially 56,000 demand zone. This would be painful, and it would test everyone's conviction. But here's the key. Even in this scenario, if you look at Bitcoin's history, these deep flushes into major support with the market in extreme fear have repeatedly been the setups for the most explosive recoveries. The invalidation of the entire bullish thesis would only really come with a sustained, decisive weekly close well below the mid-50,000s. Short of that, even a deeper flush could still be a bear trap that shakes out the last weak hands before a reversal. So which scenario plays out? Nobody knows for certain. Anyone who tells you they know with certainty is lying to you or to themselves. But now you have a framework. You know the levels. You know the catalysts. You know what the smart money is doing. And you know what signals to watch for to tell which scenario is unfolding in real time. Let me leave you with a practical checklist, the exact things I'd be watching over the coming days and weeks to stay ahead of this market. Number 1, watch the 200-week moving average in the low 62,000s. Holding it is bullish, losing it decisively is a warning. Number 2, watch the 64,000 resistance. Reclaiming it on a strong close is the first sign momentum is shifting back up. Number 3, watch the ETF flows. Consistent inflows returning would be a major bullish confirmation that institutions are stepping back in. Number 4, watch the whale wallets and exchange balances. As long as whales keep accumulating and exchange balances keep falling, the strong hands accumulating thesis stays intact. Number 5, watch the Fed narrative. Any shift from hawkish to dovish, any hint of rate cuts, any cooler inflation data would be rocket fuel for Bitcoin. And number 6, watch the fear and greed index. When it starts climbing out of extreme fear, that's often when the recovery gains real traction. Here's the bottom line, and I want you to really sit with this. The headlines will tell you Bitcoin is crashing, the Fed is the enemy, and Saylor stepped back. So the top is in. That's the surface. And the surface is designed to make you emotional, to make you panic, to make you capitulate at exactly the wrong moment. But underneath that surface, the data tells a more nuanced and, frankly, more interesting story. The largest, most sophisticated players in this market are quietly accumulating while the crowd is scared. Coins are moving from weak hands to strong hands. Leverage has been flushed, sentiment is washed out, and Bitcoin is testing the most important long-term floor it has. That doesn't guarantee anything. But it does mean that this moment, this scary, uncomfortable red candle moment, is exactly the kind of moment where fortunes have historically been made by the patient and lost by the panicked. Which one you want to be is up to you. If this breakdown helped you see through the noise and understand what's actually happening beneath the surface, do me a favor and hit that like button, because it genuinely helps this channel reach more people who need to hear the real story instead of the fear-driven headlines. Subscribe and turn on notifications, because in a market moving this fast, being a day late can be the difference between opportunity and regret, and I'll be tracking every one of these signals for you as it develops. Drop a comment and let me know which scenario you think plays out, the bullish reclaim, the grind, or the deeper flush, and tell me what you're doing right now, accumulating, waiting, or sitting on the sidelines. I read the comments, and I want to know where your head is at. And remember, and I cannot say this enough, nothing in this video is financial advice. I'm not your financial advisor. This is analysis and education based on the data available right now, and this market can and will do things nobody expects. Never invest more than you can afford to lose. Never use leverage you don't fully understand. And always, always do your own research. Manage your risk, protect your capital, and think in terms of years, not days. That's how you survive long enough to actually win in this game. Because the people who win in Bitcoin aren't the ones who make the flashiest single trade. They're the ones who are still standing after the volatility has shaken everyone else out. Stay sharp, stay patient, stay disciplined, and I'll see you in the next one.